Well, look, I think there's a few people joining, so we'll let people join. But as I think we're just past 10 o'clock, I think we'll get started. I'm in control of the presentation somehow, so let's hope we don't have too many technical hitches along the way. But yeah, so if you're just joining, I'd like to welcome you to our our coffee conversation. We're very pleased and proud to have Atul Vadher come along, who is the branch chair of the CICM for the East Midlands branch, I believe, Atul.
That's
and
correct,
he's
yes.
also an advisory council member of CICM as well. So it's good to get some time from him and maybe get into a conversation on a couple of topics which we'll discuss as we go. I love the title, Atul, Credit Where Credit's Due. Is that credit where credit's due to you for that title? Is that all your own work, or am I going to find that somewhere else?
Oh, no, that's all my handiwork, that is.
Okay, so I was going to patent that for our next Visma Onguard book.
As long as I get the royalties, that's fine.
Yeah, so loving that already. If you are on the call now, excuse me, my voice is going a little bit, but if you are on the call, there is a chat function. So if you want to throw in any questions or comments or views or opinions, then by all means do, and I'll do my best to pick that up as we go. We want this to be a sort of a conversation rather than a Q&A. So by all means do chip in. It's not a masterclass or a structured seminar or anything like that. It's just an open conversation with a sprinkling of experience from someone who's Atul, that is, who's obviously well connected with CICM and has spent his entire career in credit management. And also I'm going to bring in some of my own experiences through my working life as to how some of these topics have affected me. We're going to try and cover just two topics today. Hopefully we won't finish too early. If we do, I've got a third topic in the background if we need it. But we're going to talk today about KPIs, and in particular DSO, days of sales outstanding. That's an area we're going to talk about. And then we're also going to talk a bit about credit insurance and have a bit of an open conversation as to how that works. So I think we'll crack on and we'll start having a bit of a discussion about DSO. Prior to this this conversation, I ran a poll actually on LinkedIn, and I had a lot of views on this, and actually a lot of votes, about 60 or 70 people, Atul, to discuss DSO, because I'm in the business of selling software. All of my competitors do the same thing, and we bang on all the time about, hey, buy our products and your DSO will come down by 20%, 40%, or whatever those claims tend to be. But I also end up, when I talk to a lot of people, sometimes they say, well, Andy, we don't really use DSO or whatever. So I ran a bit of a poll over on LinkedIn, and I have to say I was very pleased with the response. There were a handful of people who were not from the order to cash community, and actually nearly all of them were in that never heard of it box. So if you take them out, based on this kind of straw poll, this says that roughly speaking, about 32 to 35%, let's call it, of people live their lives by DSO. About half of them, about 50%, because that would increase a bit when you take out the people in the never heard of it box. They do use it, but not as a key KPI. And about 11 to 15% actually never use it at all. So any thoughts on that? Does that surprise you at all, or what?
Yeah, I think, I mean, the interesting bit is the 1/5 that have never heard of it or never used it. You know, if you're in finance, you should really know what DSO is. So just depends on who they are, a bit concerning. Regards to whether you live by it or you use it, I think it depends on your role and the position you're in. If you're
Right.
a collector, just a simple debt collector, it won't have the same importance as someone in credit management. But just to give you an idea of what DSO is how long it takes for you to get paid. So this is averaging out, and there are a number of different methods of calculation. And I do understand some don't use it as a key KPI, but it's a great guide as to how the business is doing. Yeah, not just collection, the business. And I'll break that down a bit further later. But DSO is not about just collection. It's a lot more than just collection.
And from your experience, does the average collections team or agent or even manager, do they ever really get personally bonus specifically on this kind of thing? Or do they tend to get wrapped up in the overall company bonus? If the company does well, we all do well. Does it ever get used hard from that point of view with people, from generally speaking, or not?
I'm not sure about, I wouldn't say for bonuses, but it would be a indicator on your performance. So it is a performance indicator. You know, the thing about DSO is it's a management accounts tool on how well the business is doing. And specifically, DSO targets down to credit and collections, you know, and it's a measure of credit and collections from an accounting perspective. You know, when you are protecting the biggest asset in the balance sheet, you know, you've got stock, which is liquid, cash, which is very liquid, but your debtors are either going to be cash or bad debts. Yeah, so you're protecting a very important asset, and the survival of your business depends on how quickly you can turn that asset into cash.
And do you think I go back to a particular piece of my experience. If I go back to the credit crunch of 2007, 8, 9, whenever that was, I was minding my own business as the CEO of a major corporation in the UK. So you're looking at a £600 million business. Mm-hmm. I was, as a CEO, formally put on DSO as my bonusable objectives. So this mattered. This was 25% of my bonusable objectives were on something which I later, I discovered was called DSO, for which my first reaction was, I don't even know what DSO is. I had to get my CFO in to explain my DSO, because suddenly money can't. Now, this was a Japanese company. I don't know if they were just panicking a bit, but this is a $1 billion corporation, so one of the biggest in Japan. I have never yet, in all the times I've been now out with software trying to sell it, I have never yet found any other CEO that's formally been bonused on it at that level. Not even a CFO, probably. Don't know.
Yeah, I mean, it's quite an interesting question really, but and a position, and it's all down to understanding what DSO is and why. You know, it's easy for a business to say, look, I want this reduced. Now, I'll come back to a point which I was going to mention previously. It's a good point to mention DSO. There are a number of ways of calculating DSO. There's rollback, there's add back, there's the one that's used in formal financial accounting, which is your average debtors over 12-month sales times by 365 days. Now, that's great. That's the accounting version. But it's really your debtors' relationship with your sales. So if your sales start dropping and your debtors start going up, that affects your DSO. So the question is, which one is it? Why is your DSOs going up? Is it due to the effects of your sales, or how long it's taking you to collect? Now, the other factor I put in when I calculate DSOs is breaking that DSO down to categories, because you've got extended credit. Now, if your business has offered 150-day credit on your biggest debtor, which makes up 50% of your debt, your DSO is going to be skewed, totally skewed. And vice versa, if you've got 1/3 of your debtors book in query, again, it's skewed. So what I used to do, what I loved doing, is taking your DSOs and then breaking it down into sections of days to say, 10 days of the DSO is due to extended credit outside of the terms of the business, which could be 30 days. 2 days are due to query. So now you can target. Now, this is where credit comes in. By targeting your DSOs in that way, you actually say to the business, look, if you want to reduce your DSOs, we need a better response on your queries. We need a better strategy on queries. If you want to reduce your DSOs, we need to be tighter on our terms. If we're extending terms and sale or return terms or extended credit terms, this is all that skews your DSO. So it becomes an information tool for credit managers to say, look, that's a great measure, but these are the breakdowns of those measures. And if you want to reduce this, that's where the business has an issue. So to me, DSO pinpoints where the business issues are.
Yeah, it's coming back to me now. I think it took me about a quarter of not getting my bonus to start understanding exactly how the calculation worked. And then it took me the next quarter to start really driving it. And I think as CEO, I ended up being head sales guy for the big accounts, i.e. it was down to me to go and get the thing paid on the 30th, not the 2nd, because otherwise the Japanese worked a very strict metrics. You make it or you don't, that's the end of it. But I remember going into about the third quarter, I think from what you were just saying, I started to say, well, hang on a minute. There's no point me taking this big order from this big retailer because that's going to impact my DSO and I'm not going to get my bonus. And therefore, we need to have a discussion, management team, heads of business. Do you want me to sell or do you want me to wait? And so it started to, I wouldn't say it started to drive the wrong behavior, but I would have adopted the wrong behavior had they not capitulated. From their point of view, I think they thought, well, at least this guy is starting to understand cash flow now, thank God. And he's not just chasing profit and market share and revenue. So I guess they got what they wanted from it. But
yeah. I mean, from a credit manager's point of view, in that same position with myself, I'd be looking at margins. The DSO is how collections are working. So instead of risking or reducing the sale, I'd be looking at the margin. Now, if there's margin in that business and it affects the DSO by 1 day, it's still business. But what you need the business to understand is the breakdown of that DSO. How much is within your control and how much is a commercial decision or a departmental decision outside of your own. Resolution of queries, disputed debts, bad debt figures, extended credits, specialist terms like sale or return or consignment. So really, a DSO is a guide into how the business is doing, but you have to have DSO because you need it with the banks and the financial position, but you can quantify it. And that quantification actually helps you develop your department and your team and the value of credit and what you're giving back to the business and what is within your control or not.
Excuse me. And any thoughts? I mean, according to the Bible, and if you're trying to take the level 3 exam, which I passed, by the way, so I'm happy about that. CICM say, well, there's 7 types of this. I think they have standard, best possible, delinquent, true, divided, average weighted. There you go. See, I've obviously learned quite a bit there. And is there any particular formula that tends to be used most? As I've been going around and talking to people with this when I'm selling software, and I say, okay, you got DSO, what formula do they use? I find the count back method sounds a bit like something else. That the count back method seems to be the one that they tend to go back to, or they always seem to have one of those 7 plus a slightly weird calculation on top.
Yeah. As I said, there are a number of DSO calculations. The one used in the financial industry is the standard, right, which is average debtors over 12-month sales.
Which is the easiest one, right?
Yeah, which also can't be skewed. It can't be skewed. You take your bottom line debtors figure, against your 12-month sales, and these are concrete, set in stone. Your count backs and your add backs and your filter backs and your assumption that if you imagine none of this has been paid, they're all tweaks and they all send a different message to the business. However, I've been in businesses where the credit department would use one method, but the financial accounting would use another method. And the one that's used by financial accounting is the one that's recognized outside of the business from an audit point of view to the banks. So really, there's 2 different measures, and it's depending on what is it you're trying to say. Are you trying to emphasize your sales, your collections, or your issues?
Right.
And that's what it is.
And I think if you use credit risk companies, I know that we partner a lot with Credit Safe within our tool, and I've gone through their fantastic sheets, and they've got 5 years of your DSO and everything else. I'm pretty sure they tend to use the standard DSO method. So because it's relatively simple, right? It's your revenue divided by 365 days, and then if your terms are 30 days and this says 60, you've got 30 days of your revenue tied up in customer finance, right?
Well, it's universally recognized because standard accounting calculation. Where I was previously in a few different locations, credit did a different variation of DSO. So I realigned it to show in the business. The difference is one's more stable. The accounting one is more stable because it takes into account your peaks and troughs in sales, whereas the countbacks won't do that. If your sales in this month shoot up, your figures will change. So they send different messages, but for me, it's not really the DSO; it's the breakdown of the DSO. Why is it so high? How much is each element worth in days? Queries, disputes, and the rest.
And do you tend to find that people, although they do use DSO, there's actually a tendency, there are measures that matter more, if you like, such as age debt, age beyond terms. I often find people are often more concerned about how much age debt they've got. Like it's far worse having 50k in 90 plus than it is having 500k in 0 to 30, for example. So do you feel that age debt in theory is a better measure?
Do you know what? There's various measures. If you look at managed or general accounting, there's different ratios tell you different things, and it's a combination of that. Your DSO is one report. Your age debt analysis and the aging of that is another measure, and it's just as important, sometimes if not more important. Because if your debts are getting older and older, there's more of a risk of a bad debt. So that's more ground level, whereas your DSO is at a higher level. So they're both working hand in hand, and they both send a different message.
Let's move on to credit insurance. Probably just as, I don't know if you can see the poll here or whether I'm covering it up. I can sort of see the bits.
Yeah, I'm good.
I didn't get as good a response to this poll. Whether it was the way I worded it or not, I don't know. But again, I based it on some bitter experience I had in my previous job when credit insurance suddenly got pulled and I was in a right pickle. So I banged out a quick poll to people again saying, is it a situation where you can't sell without it? Your company won't let you sell outside of insurance. Is it something that you just can't afford to sell with it? It just costs too much money, so I can't, it's whatever. Or are you self-insured? Or basically, have you got no low risk, so you don't need it anyway? Now, I was quite surprised that only 13% kind of came back to suggest that they are insured. That for me felt low. However, I was on a credit forum this week, and there was a gentleman from Aon on there talking a lot about where credit insurance is going. So I dropped him a note privately just to say, hey, Fred, matter of interest, what percentage of companies actually are insured? And funnily enough, he came back and said, Andy, it's about 14%. So actually, that 13% is pretty close. He said it's probably higher with B2B and B2C, but that feels quite low to me. I don't, again, working for that Japanese company, the general policy was if you're not insured, you can't sell above that limit. Does that feel right, that sort of 85% of companies don't bother? They either self-insure or they've got their risk so low because their collections team are now so good?
I think it depends on the reason you want to insure, in my view. If you're insuring as a safety net, as a different emphasis, if you're insuring to fund your business because you've got high risk customers, or if you have robust systems within, you might say, well, I don't need insurance because my experiences are low. So it just depends on how you look at credit insurance. As a credit manager, what are the reasons you want credit insurance? Is it to protect your debt? or is it for information? You know, I mean, I love credit insurance. However, as a credit manager, it doesn't make my decisions. As a credit manager, I make my decisions. And to sum it up in a way, for me, it's like car insurance. You know, you're covered, and you get car insurance in the event of. But how you drive is your risk. So a lot of credit managers will say, well, I can't give them credit because I can't get insurance. Whereas for me, it's part of the decision making. Can I get insurance? No. Why can't I get insurance? What are the reasons? Am I prepared to take a risk on it? So it just depends on, in that poll, it depends on the setup of the business. You know, if it's got a really solid setup, cash rich with less experiences, you might want to self-insure, which makes sense. However, you know, if you're a larger corporate, then it's a bit of information as well. Because don't forget, what the information you get from an insurer on a debtor, you can't get in financial accounts or reports.
It's an expensive bit of intelligence, though, isn't it? I was trying to think back to that time when I had insurance, and I was trying to think what we were. I'm pretty sure we were in the region of $750,000 a year. We were spending on insurance to cover about 600 million as a book, and I think even then we weren't fully covered. But but who do you think is taking the decision as to whether a company should be insured or not? Because going back to my experience, I became the CEO of this business. I inherited the fact that our policy was we had to be insured. Didn't think no more of it. Obviously, it was a decision somewhere from up in the sky. I later found out it was kind of the policy of the corporation. And then when I spoke to my CFO and said, my God, this is costing us a fortune, and we seem to be insuring stuff that's safe anyway. A bit like insuring your car, but it's still in the garage all day. And he said, well, it's company policy. So from his point of view, he didn't have that decision-making power. So where do you think, who drives the decision as to when a company is going to be insured or not? Is it brought forward by the credit team or the CFO, or is it drilled down from someone higher up that's had a bad experience sometime before?
I would say both. I would say both. The reason I would say both is if you look at it from top down, banks, when they look at your financial accounts, like the security, you've got insurance. So as a business, they will look at your accounts and say, well, although you've got debtors of so much, you've got credit insurance, which allows a risk factor to be taken into account. Yeah, from a credit bottom up, you would then say, look, this is our portfolio. I'm concerned. I think there's a, COVID-19 around the corner. I feel something's happening, something's brewing. If we get credit insurance, we're protected to an extent. I can see companies going out of business. So that's when it goes from bottom up. So it's a combination, but it becomes a great tool for financing. If your business has your debtors with a credit insurance in place, from a bank's lending point of view, it's a positive. Because so part of your risk is covered. But then it depends on your type of credit management, because that's really important. Because don't forget, if an insurance company pays out, your premium will go up. It's going to happen. It's going to happen. But you're going to need to know what the terms are of your contract and how you are protected.
What about COVID? Because you would assume that with COVID, everyone would be rushing for insurance, and the insurance companies would be saying, ha, here's a good opportunity. But I understand that the actual amount of insured risk at the moment, if anything, has gone down slightly, and that the loss ratios of the major insurers, they are creeping up, but more so to do with protracted debt than to do with insolvencies. That they are expecting that to come, but at the moment, any views on that relationship between COVID and insurance? Because it almost suggests it would go up, but actually it's not. Any thoughts around that?
Yeah, I mean, credit insurance is based on your terms and payments. If most businesses are closed, there is no sales or limited sales, and at the same time, you're extending terms of payment. So the way credit insurance works is that you have a period of time where you've got to lodge a claim for or notice of non-payment. And if you're extending terms because of COVID and relationship and the rest, you're going to be outside of terms, which will then affect businesses in going out of trade. So there is a link, and it is understandable as to why. But the time you really want insurance is when business is quite brisk. At the moment, it's in a lull. So what are you insuring? If you're not delivering a product, what are you insuring? And the cash at the moment is moving around quite freely. Companies get availability to cash as well. And a lot of businesses are sort of just surviving. So insurance companies won't insure you on your past debtors. They'll insure you on your future sales. Yeah, so you can't go, that's my portfolio, they're out of date or now overdue, will you insure it? No, it's on future. So you're going to need to know what the terms of your policy is and where you can and can't draw the line.
And are the terms much of a muchness? You mentioned car insurance. I know that if you went to 5 or 6 different insurers, you'd get slightly different amounts, but they're not wildly different. I think we have 3 major companies that cover about 71% of everything, and about 40 others that cover the rest. Do you tend to find in your experience that they differ wildly, or does some refuse to give cover on some companies where others might, or do they all follow each other down the same path? The reason I ask is when I was managing this large business, my insurance cover for Dixon's was suddenly reduced from like 50 million to 20 overnight, and then all hell broke loose because we were at least 45 million. And in the end, the response from my parent company above, whose policy was you can't sell uninsured, was something along the lines of, Andy, you can't sell uninsured, but you're the boss, you take the decision and don't screw up. So I just basically had sleepless nights for a couple of months, worrying about what was going to happen to Dixon's. But I remember we tried to go to another insurance company, but we kind of got the same. My credit manager said, Andy, it doesn't matter whether you go left or right, they've all dropped Dixon's cover. You're not going to get someone that's suddenly hasn't worked it out.
Well, each insurance company will have an underwriter, right, and they're looking at pretty much the same data and same information. The difference between the credit insurers is if you've got existing policies on that debtor. Yeah, so this is where I find credit insurers quite useful. If, for example, company A, an insurer is insuring your business or a customer, and you actually lodge a claim for late payment, the insurance company would give me a warning that a claim's been lodged. So that means I'm going to be more cautious, which is more current, a lot more current than financial reports. So again, different insurers will look at it differently, but the risk appetite is where it's down to, and also what's within your policy and the after service, because credit insurers will also provide you collections, and you'll have your first loss ratios and the rest. So that's where it's important. It's what's in the policy, what are you covered for, and how quickly do they react.
Yeah, and as I said on that call the other day, it suggested that their loss ratios are increasing, mostly to do with protracted default, not insolvency right now. But ironically, I think the government has also allowed companies to delay the submission of their annual results, if you like. Yes. And so obviously credit companies are saying, well, my data for this company is now so old, I'm putting up the insurance premium because I don't know. So it's odd how all these government initiatives are all having impacts on other things.
I think that's one factor. I don't think it's the only factor with credit insurance, because they look at payment behavior. So if you've got a customer or a debtor with a number of clients, and they're all paying reasonably, then your rating will take that into account.
Right.
Yeah. So it's not just based on financial reports, it's payment behavior as well.
Right.
Of other policyholders for that debtor. Yeah. So that's the important bit. And that's the bit of information you won't get in financial reports, which is payment behavior to your portfolio of clients.
And how would a company self-insure, Atul? Do you simply have to kind of build a war chest on the balance sheet somewhere, and then it's...
Yeah, to self-insure, you've got to be able to evidence that your experiences past are less than your outgoings on premium.
Right.
Yeah, and going forward, you can maintain that.
Right.
Now, if you're in a position to say, I can maintain that, and then you're hit with a global recession, which you had not expected,
Yeah.
then you're stuck.
Right.
You know, and you know, financial lenders will take that into account.
Right.
So it just depends on the horizon and how risk averse you are.
Right. Okay. Well, look, we're probably out of time. Actually, that went a lot much quicker. I think we could have covered a lot more ground on both of those subjects. So I'd really like to thank you on behalf of Visma Onguard for joining in on this. Hopefully, we could probably come up with a couple of other juicy subjects in the future, if that's okay with you.
That's fine with me.
And I'm conscious it's Earth Day today, so we need to be out there planting a tree or not eating meat today, or doing something to justify Earth Day. So I'll leave it at that. And that's all. Thank you very much for your time. And
thank you.
And have a great Earth Day.
Great. Thank you.
All right. Take care.
Bye.
Thank you.
Everyone.
Bye bye.